Welcome to Module 3. Debt is a tool, not a demon. I know that for some of you have a lot of debt and this is a very emotional topic. I know others of you don't have any debt. And so just I want you to know that even if you have no debt at all, this module will still be helpful because in the second half of the module, we talk about how you can leverage debt and use debt as a tool. So either way, this will be helpful. What we're going to do is we're going to start on focusing how to get your bad debt in control and what some options are for that beyond what we already talked about in Module 1. So first, let's review Module 1. Does having debt mean that you are undisciplined with money? No, not necessarily. Most of us just were maybe handed credit cards that we didn't understand when we were 18. Others of us were handed student loans that we didn't understand. So a lot of this is not our fault. So I know I can't tell you to take the emotion out of the debt because I know that emotion is there, but just know, like, if you can try to have this feel just a little bit lighter, knowing that it's not all you and that there's tons and tons of people in your situation. Review number 2, what is the rate slayer strategy? Think about that in your head. I'm going to show it to you on the next slide. And then number 3, why is a 7% guideline based on a 7% interest rate? So as a reminder, we use 7% as the line where we cut the good debt and the bad debt. Any debt that has an interest rate above 7 is considered bad debt. Interest debt below 7% is medium to good debt. So here's this rate slayer strategy. Remember, we line up our debt in order of interest rates, and then we pay minimums on everything except the one with just the highest interest rate. So let's say you've done that. You did it, you did your homework for Module 1, nice job, but your strategy still looks hopeless. Maybe the amount that you're supposed to pay each month just to cover your interest on, say, your highest interest rate credit card is you just can't make it. You're just not making a big enough dent. What can you do? Well, you have a couple options. First of all, you can consider 0% interest credit cards. So those act like a band-aid, and all they're doing is stopping the bleeding. So this is not a permanent healing if you do have some kind of overspending problem. But like I said, it's for a lot of us, that's not the issue. But it helps us get ahead. It stops the bleeding. So here's an example. Let's say you have $5,000 on a credit card and it's at 29%. And that's going to be $121 a month roughly of interest. But what if you're only putting $100 a month on the credit card to pay it off? Well, that means your balance is still going up. And that feeling is horrible. When you're throwing $100 a month at something and the balance keeps going up, that's not a good feeling. And so the great thing about a 0% intro credit card, it doesn't stay zero forever. So you do have to be careful. But you have then, 18 months or 12 months to get your payment under control and actually start making progress. Because you can really cut down the balance a lot when you don't have any compounded interest building. And so basically you're saving $1,450 a year by going to that 0% credit card. Well, that's huge. Now, keep in mind that you've got to be careful again because these have a transfer fee. And so what you want to do is you want to find the best cards that just have minimal transfer fees. And I'd say a fair price for transfer fee is about 3%. That's pretty standard, but some do go higher than that. So for example, you don't want to have it be a minimum of, let's say, 6% for the transfer fee. And then also a lot of these credit cards require a good credit score, like 670 or higher. Sometimes you can find ones that let you have a lower credit score, but they're a little bit harder to find. Because of the 3% transfer fee, these are recommended if you're going to take immediate action. Because if you pay a 3% fee to transfer the card, but then you don't actively pay it down, well, the fee is just going to go, the interest rate is just going to go right back up to 29%, or some of them now are 34% I've seen lately. Okay, so just make sure that you're actually paying it down if you go this route. And then in terms of where to actually find the best cards, the best offers are consistently changing. And so bankrate.com or NerdWallet are two excellent unbiased sources, or I guess relatively unbiased, about as unbiased as they can be. All right, well, what if your credit score is too low for a 0% card? Well, then you need to fix your credit score. One way to do that is just to fix it yourself. And the way that you can fix your credit score is by looking at those FICO score components and just start to get your credit in order. One is simply payment history. Just start making on-time payments. Even if you can't make a big payment, just make payments. That helps. Your current debt, how much debt you currently have, is, the more you pay it down, the better that'll be. The length of the credit history, your new credit inquiries, that's a small one. I feel like sometimes there's blog articles like, oh, don't get too many credit inquiries at once. And I mean, that really only nicks you temporarily. So that's not the hugest deal. But it can impact you, for example, if you're about to buy a house and it's like every point matters, that's when you got to be careful about the new credit inquiries. And then credit mix. So by having a greater diversity of credit, you can actually increase your score. So having maybe a home loan and a car loan and a credit card, for example. Now you can monitor your credit on Equifax, Experian, and TransUnion, and you can get free reports each year from them at annualcreditreport.com. All right, so let's say you try to fix your credit and it's still bad. Okay, this is where credit repair companies come in. And honestly, I don't recommend these for most people, but I wanted to at least acknowledge them. The reason I don't recommend them is one, that they have fees, and also you get locked into a plan. And then once you're locked into that plan, you have to stay with it, or then it can hurt your credit even more. But in certain cases, they can be helpful. So, for example, if your credit was wrecked because of fraud, well, that's where someone like the credit repair companies would come in, because they'll actually go to bat for you. And a lot of these credit repair companies, some of them have a good team of legal attorneys where, if you have to like go to all the different reporting companies and get things fixed, they're just better at it, where for us it might take us several months to do that. They know how to do it a lot faster. So, in certain cases, I think of this as a last resort, but they're there if needed. Okay, I'm going to move on because I know some of you don't even have credit card debt. So moving on to student loans. Now, I know a lot of you do have student loans. And let's start by looking at just what the income-driven options are for student loans. The income-driven options matter because these are tools where you can potentially pay less interest and get loan forgiveness. So the good news is actually is that this used to be a very, very complicated decision. I know some of you are thinking, wait, it's still complicated, right? And it is still a little complicated, but because the SAVE plan was recently introduced, it's SAVE is significantly better for most people. Not everyone. I'll of course talk about all the exceptions, but for a lot of people, the SAVE program is a no-brainer, and that's because the interest is forgiven. So every month that you can't pay it. So for example, let's say you have a payment that is a payment of interest for $300, okay? But your actual payment under Save is only $100. Well, that means that you have $200 a month that you're not paying of interest. Now, in the past, what that would mean is that your balance would be growing and growing and growing because you weren't even covering your full interest under your income-driven payment. But now with the SAVE plan, the government forgives that. They just get rid of that $200. So you pay your $100, that extra $200 of interest that you didn't cover, they get rid of it. So to be clear, your balance is not going down, but it's also not going up. And so this is really great for, like, for example, while you're in school, in grad school, or while you're in a low paying job before you get a higher paying job, such as residency or fellowship, or even just in any career. It's not just medicine. In lots of careers, you start out with a lower income. And then while your income is low and you're not able to make big payments, sometimes the payments are even zero. Your interest is getting paid, which is huge because that was the big problem before. I think I've said this before, many of my former clients were doctors, and so I would see absolutely crazy balances because it would start off at only $250,000 of debt, which, only, but in medicine, that is pretty standard to have loans in that amount. But then if you're in a 7-year residency and fellowship, I mean, these these balances were getting ballooned up to, 400, 500. I think the record was about 800,000 one of my clients had. And so with that compounded interest, and it just killed people. And so under Save Now, that issue will no longer happen. And so that's why for most people, the Save program makes sense. It also has the greatest variety of forgiveness options, which we'll talk about on the next slide. But for some of you, I'm going to go down to pay as you earn and IBR next, the two bottom ones, because they're pretty much the same. For some high income earners, and when I say high income earner, so it's not just about your income, it's your income compared to your total debt. So if your income, for example, is like 3 times the amount of your loan, okay, oftentimes it's going to make more sense to do pay as you earn it or IBR because your payment is capped at the 10-year standard payment. And this only makes sense if you start out with a lower paying position and then you end up in a higher paying position. And so for many doctors in higher paying specialties, for example, pay as you earn or IBR can make sense instead of Save. Now, one thing to keep in mind about pay as you earn is that you're no longer going to be able to go into this plan starting in July 2024. That's the current plan anyways. I know that could potentially change with legislation, but for right now, that's how it is. So you do need to make a decision if you're going to stay and pay or enter pay before July, and then after July of 2024, if you've been in the pay as you earn program, you wouldn't be able to, for example, go off of pay as you earn and then get back into it. But you would be allowed to continue on pay as you earn. And the reason why having it capped at the 10-year standard payment could make sense for higher income earners is that, let's say you have, 5 years of low payments during training, and then you have those 5 years of the higher payments. So that way, your 5 years of those higher payments have a cap on them. The difference between pay as you earn and IBR, income-based repayment, is really just that for some of the IBR programs, the payment amount is based on, IBR is based on 15% rather, where pay is based on 10%. If we're utilizing these for caps, it doesn't really matter, but where it would matter is while you're in training and you're not going all the way up to that cap. The next payment type, this is in the upper right hand corner, the ICR. ICR is really the only option for Parent Plus loans. And so that's an important option to keep out there. And also every once in a while I've noticed ICR, just because of the calculation, turns out to be a little bit better than Save every once in a while. Believe it or not, that was the simplified version of picking an income-driven repayment plan. Please reach out, if you have questions, because I know this can get it can be a little bit much sometimes. All right, so this is a good part. All of these complicated rules and all of the paperwork that you do, it all ends up worth it. And this is how you feel. I have gotten loan forgiveness. I did the middle option, the teacher loan forgiveness, and it is absolutely an amazing feeling. Before we get to teacher loan forgiveness, I'd like to start with the IDR forgiveness because that's the kind that we were just talking about. And in IDR forgiveness, you don't have to be in public service or be a teacher. Anyone can get IDR forgiveness. IDR just stands for income-driven repayment forgiveness. So if you get on any one of those 4 plans I just showed you, you can get forgiveness in either 5, 10, 20, or 25 years. Or in this case, actually not 5. That's just a teacher loan. You can get forgiveness somewhere in between 10 to 25. Okay, so if you have a large balance, in many cases, you're going to end up 20-year forgiveness for undergrad loans or 25 for graduate school loans. If your balance is smaller, that's where you can get it under 20 years. It can be anywhere between 10 to 20 based on how large your balance is. There's a lot of details on exactly how to calculate that online. I don't think I need to go over that right now, but again, if you have questions, reach out. And so basically, you get the forgiveness, And then the one catch is that it's usually taxable. And so you do have to save for what's called a tax bomb. So if you ever read articles about student loan tax bombs, what they're talking about is that the amount that you get forgiven, that is generally taxable at the federal level. Of course, I have to say generally because right now we're in one of those years where it's not taxable. It's also looking like most likely 2025 it's not going to be taxable. I say most likely because these rules about what's taxable, what's not taxable, some of this stuff is changing. And I would encourage you, because these are, I can't promise what the government's going to do in any given year. Um, Keep up on it, reach out to me. I talk a lot about all the updates on TikTok. And so it's just, if you ever have a question, just reach out and we can discuss it. That's also what this group is for. Reach out to the group on the community online group and also come to the mastermind and ask questions because I'm sure that details of loan forgiveness will be a key topic in our discussion groups in our mastermind group. So anyways, usually taxable, but if you get it to forgiveness in 2024 or possibly 2025, no tax. So that's actually really good news. Okay, moving on to teacher loan forgiveness. The main drawback of teacher loan forgiveness is that it's only 17,500, which is a great chunk, but a lot of teachers have master's degrees and have more than 17,500. And one thing to note about the process, and this is what I tell everyone regardless of whether you're getting a teacher loan or not, it took me 2 years to actually, like after I submitted the application, I had already worked for more than 5 years and I did all the rules. Still, even if you do everything right, it can still take 2 years to actually get forgiveness. Hopefully that it's better now. I mean, part of this whole reform of student loans is it's supposed to get easier, right? So we'll see. Moving on to public service loan forgiveness. The nice thing about public service loan forgiveness is that for example, for teachers and for other people in public service, it doesn't matter what your role is. You can be in any position as long as it's considered, a state government, federal government, or a nonprofit. So teaching hospitals, like most universities that are public, all qualify for public service loan forgiveness. Nonprofits generally qualify. There are nuances, and every once in a while there's weird situations. Like, for example, at some teaching hospitals, it's partially private and partially public. And I've even seen a situation where certain residency programs got loan forgiveness and certain ones didn't. They weren't considered a qualified program. So it can get weird, and just talk to your employer to find out if your employer qualifies for public service loan forgiveness as a qualifying institution. And then the rule is you have to have just 120 payments while you're working at a qualifying institution. So when people see 10 years, some people think it has to be 10 years straight. It doesn't. So let's say you worked at a nonprofit for a few years, but then you took a break and did something else, and then you went back to working at a nonprofit. As long as you have 120 qualifying payments total, those all count. And then the really nice thing about public service loan forgiveness is that there's no federal tax. That's huge. Moving on to home mortgage debt. Home mortgage debt is a fun area because it starts to get into the idea of debt as leverage, but it's also a little bit nuanced because while your home could sort of be an investment, and therefore that would be leverage, viewing the debt as leverage, people use it the other way too, and people end up in homes that are way too big, way too expensive, and it's really not an investment. It actually becomes a burden and it becomes a money pit. And so it's really important to follow this number one rule, and that is don't become house poor. So what is house poor? House poor is just where you just bought too much house and that is taking over your life. And it's not just the mortgage that you have to worry about, that mortgage payment. It's all of the home fixes. It's all of the interest that goes along with the mortgage. I mean, the interest is part of the mortgage, but it's everything. It's also just the type of neighborhood you move into. If you buy a more expensive home, there's more pressure from your neighbors to bring the good wine to the potluck instead of the cheap wine. You feel like you have to keep up the yard. The bigger your yard is, the more yard work you have. Are you going to do that yourself? Or are you going to hire that out? It's just lots more responsibility. So in order to have a healthy financial plan, it's recommended to finance at most 2.5 to 3 times your annual salary. Now, I know some of you are rolling your eyes saying that's literally impossible right now. I know. Here's the thing. Let's say, for example, that your salary is 100,000, and then that would mean you would your mortgage would be 250 to 300,000, right? So if 300,000, if you're thinking that there's just no way, there's nothing available, then you just have to save a little bit longer. So like let's say the house you want is 400,000, then that means you'd put 100,000 down and then you would finance at 300,000. So it's not that you can never go above that number of 2.5 to 3 times your salary. It's just that's the most you'd want to finance in general. Now, are there nuances to this rule? Of course there are. So even in like lower interest rate environments, keeping to this general rule is safe. And if you read books, like if you've ever read The Millionaire Next Door, their standard is at most 2 times your salary. But again, I mean, in our current home buying environment, finding a home that's 2 times your salary is going to be pretty hard unless you have a pretty healthy salary. So I think stretching that right now to 3 times is reasonable. Let's talk about some home mortgage miscellaneous tips. First of all, the concept of when does it actually make sense to buy? And generally, the break even point is 3 to 5 years. And so if you're living somewhere temporarily, don't put pressure on yourself to buy a home. Just because your friends are or your neighbors are, it doesn't mean you need to buy a home. Okay, so the years when you're young and you're going from job to job or you're traveling a bit, just enjoy renting. Renting is fun. Renting is easy. Don't think of it as throwing money away because yes, I mean, yes, you're not paying down a mortgage, but remember, people who own homes are having to throw money into yard work and fixing the house and then all that interest. So renting it's not always bad. And in certain markets, renting is way more affordable than buying a home. At certain times, it's the opposite. At certain times, buying is a better option. And so look at your situation, look at the market. Um, One other kind of, I guess this is a random tip, is the variable loans. I want you to be careful with those because anytime you have a variable loan, then you have an unpredictable part of your financial plan, and that's a significant expense that's not predictable. So even though variable loans can sometimes, you can get them for a little bit cheaper sometimes. Maybe you can get a loan at, 3% instead of 3.5, but the problem is I mean, if you can get a 3.5% loan, I mean, hopefully those days will come back. Uh, but, lock that in, okay? Because variable loans, you just never know. I mean, right now people think the loans are crazy high, around 7%, but it could get worse. They've been worse. Okay. Another tip for when you're buying a mortgage is they give you things where you can buy down the rate and you use these points. And when you're doing that and you're buying down the rate, maybe it costs you $2,000 to save, 0.25%, something like that. You just calculate the break even point. That way you can decide what makes the most sense. And then the last tip is if you're one of those lucky people that has a 3% loan, please do not pay extra on it. I mean, 3% is a magically low loan. Anyone that has that rate is doing great. And there's so many more things you can be doing with your money than paying down a 3% loan. Because remember, those dollars that you're putting into that 3%, you're getting essentially a 3% rate of return on those dollars because you're no longer having to pay 3%. Where getting back to the concept of the 7% guideline, it's 7% because in the stock market, on average, you're going to get at least 7% per year over any 30-year time period. All right. One other benefit of having a home is you can have a home equity line of credit. Now, these are also known as HELOCs. And HELOCs are really helpful because you sometimes just need some cash. And even though HELOC loans don't always have the best interest rates, they're usually a little bit higher than your home loan rate. When you need cash temporarily, they're a great option because For example, you don't have to take out a whole extra credit card. And credit cards sometimes, they might have a limit. Maybe you can only get 20,000 when, let's say you're doing a construction project. You don't necessarily want to have to take out a construction loan. And so having a home equity line of credit, it just gives you access to a line of credit based on the equity in your home, which is wonderful. And so they're very helpful. But be careful because they tend to have variable rates. And so because it's a line of credit, and so rather than it being a fixed loan, it's a line of credit and you can pay it back kind of however fast you want. And so if it does have variable rates, it's possible to get in trouble. And so that's why I think it's good to think of it as a short-term loan. So banks have short-term loans called bridge loans, but by having just a home equity line of credit, that's essentially the same thing. All right, moving on to small business credit tips. This is one other example of where leverage can be really useful. And you want to have leverage both for on your personal side so that you could have money to start a business and just have a little bit more of a cushion in an emergency. But then you also want your business to also have leverage. And so the way that you do that is once you start a small business, you want to incorporate it. And Danielle is going to deep dive into this, so I won't talk about it too much. But for example, you can get an LLC, for example, is what she's going to talk about. You get an EIN number and a business bank account, and then you can apply for a business credit card. And that's really the first step to building your business credit. So some people just forget to do this, and then they later on realize that they need some leverage, but then they haven't taken time to build their business credit. So that's my main tip there. And then Danielle will deep dive in more about starting a business in module 5. I hope that opened your eyes to at least a couple of things for both how to pay down your debt efficiently and also how to use debt as a tool. Remember that debt management can be emotional and just give yourself some grace. You'll get there. I know it seems impossible sometimes, but a lot of people have been in your shoes and they've gotten over it. And so you can do it. Let's start by thinking about what step you want to take today, what step you'd like to take this week, and then what you'll do by the end of the month. Please write these down in your journal and feel free to share them in the community group.